After a rapid peak, the prices from IPO day become a wide support range under constant selling pressure, as progressively lower downswings are made. The new year begins with the bullish continuation of a compact double bottom, but this is more of a short-term move, as a compact and a volatile double top reverses the gains rapidly. The double top is extra bearish as it has a gap before and after its 920 to 1060 range forms. This is similar to the isolation of an abandoned baby candle pattern that has gaps before and after it. Speaking of candle patterns, the double top range also runs through the center of a large dark cloud cover pattern from the second and third days of trading back in mid-September. Given the long, medium, and short-term conditions, it is highly likely the IPO range will be breached in favor of newer lows, unless a rapid influx of bullish volume emerges in the next few days. There was a normal bullish retracement with the upswing over the past week. However, this is still a very bearish event, as 535 immediately begins to be the site of bearish price action with the bearish engulfing and the long upper wicks starting April. Also, unlike most bullish retracements that at least have low to normal bullish volume, the entire upswing is mainly characterized by progressively increased bearish volume and large bearish candles, as price barely rises to the 535 resistance. The downtrend is stable as seen by the downtrend trajectory under 535 that accelerates lower with a sustainable spike in selling towards June. Interestingly, when the recent breached downtrend line is surpassed, it is at the same time July begins with the completion of a strict double bottom that presents a slight incline. Similar to the situation after the IPO, the double bottom range becomes a key support as progressively lower downswings form. The bullish reversal in July was also quick and weak due to the overwhelming long-term bearish conditions and the more recent bearish acceleration from late May. Naturally, the breach of the uptrend line and constant downswings eventually leads to the break of the double bottom range that centers around 275, which also marks the more recent gap down fill level. There is the general outline of a reverse head and shoulders, but it would be more plausible the inclined double bottom would have been identified by more market participants rather than this more obscure detail. In any case, both formations still share the same upper boundary that is clearly surpassed, with the bullish spike in early July. The pivotal upswing originating from the large bullish engulfing that starts October progresses into a steeper ascending triangle. The upper resistance boundary is widened due to the influence of the gap fill, more so than the entire double bottom range. Although a volatile and steep variant of the head and shoulders pattern has formed to break the ascending triangle's uptrend line, the overall uptrend stemming from the bullish engulfing in early October is still intact due to a double bottom forming at the approximate area where 275 and the lower uptrend line converge. A rapid recovery begins and encounters natural resistance in the old ranges formed after the IPO. This chart is characterized by considerable volatility in all time frames due to the two main factors of being a new stock and a lower priced stock well under $20 up to the present. An ascending triangle is highly valid but would have been difficult to spot due again to the high volatility and less clear swing points. Closer to the completion of the pattern, towards early August, The uptrend was already quite aggressive before the ascending triangle break, as seen by the two small gap ups in July that weren't filled immediately. Within a few weeks, the same aggressive bullish price action sees the completion of another ascending triangle with a more noticeable gap up to define a clear long-term uptrend line from both triangles. This will be useful as a correction will eventually become more likely after such a steep and sustained incline.